So you need to buy a house, but you don't want that mortgage payment. Or maybe you want to buy a house, but you don't need that mortgage payment. I don't know, whatever it is, you're looking to buy a house, you need a loan, and you're trying to find a way to make that payment more affordable because increase in prices, increase in interest rates are making your monthly payment unaffordable, and you've probably been trying to negotiate the price without knowing that you could also negotiate the price of the loan. We're going to talk about mortgage buy downs. Stay tuned, you don't want to miss it. Yes, just like you read in the title, not only are you able to negotiate the price of the home, but you're also able to negotiate the price of the mortgage, the interest rate. Why not? A lot of people think of the conventional way of doing things, which is negotiating and reducing the price for the seller, which they're not wanting to do, but they don't think of this other strategy, which is called the interest rate buy down. There are two types, a permanent and a temporary. That's exactly what we're going to talk about in this video. This is going to help you save thousands of dollars over the life of the loan. It's going to help you reduce your monthly payment, which is going to help you qualify for that mortgage more easily. And it's going to literally unlock the doors to your dream home that you think is far distant right now with the way that interest rates and home prices have been increasing. If you want to learn more, you cannot miss this video. So we're all hoping for lower interest rates in the near future, but until then, what we're seeing is a lot of people trying to negotiate the price of the home because of the increase in prices and the increase in interest rates. And this could put you in a disadvantage, especially in a multiple offer situation. If you're asking for a large price reduction, then you may be outbidded by the next person. And there's actually a better strategy related to the mortgage that can be a lot more effective, because changing the interest rate is going to make a much bigger impact on that monthly payment compared to asking for a price reduction. It doesn't matter if you already own your home, if you're looking to upgrade or if you're looking to downgrade, you can benefit from a buy down. So look into this program with your lender, talk to your realtor and let them know that this is a strategy that you want to apply. I want to give you some more details of how this works, so let me break the numbers down for you. All right, so the first thing I want to mention is that I have an NMLS, which is a national mortgage license to do mortgages. My number is 167979. The example that we're going to review is for educational purposes only. This is not an offer to lend. This is just for us to review numbers so that you have an idea of how to apply this strategy. So I want to start off by letting you know that both the buyer and the seller can pay for these points. And the cool thing about this is that instead of you reducing the price, you can negotiate the seller to give you what's called a seller credit through the purchase and sale contract that you may or may not be working with a realtor, but if you are, they'll be able to give you a little bit more information on how to structure that agreement so that you have it in writing. The common structures for these buy downs are going to be the 2-1 buy down, the 1-0 buy down, or even the 3-2-1 buy down. The most common one is going to be the 2-1 buy down. And in fact, if you're looking into buying a brand new home, if you've already gone to a new construction site, they've probably offered you some type of incentive with a lower interest rate, and it's some form of a buy down. So if you're looking to buy a new home or an existing home, this is a strategy that you'll be able to implement. And today I want to talk to you about the 2-1 buy down, which is the most common one. Let's say that you're buying a house for $400,000 and you're putting a 3.5% down payment. Just to keep the numbers easy, that's going to be about $14,000. And you're trying to decide what to do with a credit that you're receiving from the seller. Let's say that credit is $10,000. So you could either reduce the price of the home, which is what a lot of people traditionally do. Let's say you reduce the price to $390,000 instead of keeping the home price at $400,000 with the reduction in the interest rate. If you reduce the price to $390,000, you would borrow $376,000. And just for educational purposes, let's say that the interest rate is 6.875. That principal and interest payment is going to be about $24.72. Now, if we look at the alternative option, if we keep the price of the home at $400,000 and we're putting $14,000 down, our monthly payment, principal and interest at that same interest rate is going to be $25.35. So it's a little bit more, about $64 more per month. But you have this $10,000, right? So you have two options. You have the option of doing a temporary buy down, which is that 2-1 buy down that I mentioned, or you have the option of doing a permanent buy down. And if you did a permanent buy down, the benefits of doing this is that over the long term, you're gonna have a fixed payment, which means that your monthly payment's not gonna go up or down, it's gonna stay exactly the same. And the $10,000 credit that you're getting is gonna be applied to reduce that interest rate to, let's say, 6.0%. So we're going from a 6.875 down to a 6.0. That principal and interest payment is going to be approximately $23.14. So that's a difference of $221 if we compare it to the $25.35 monthly payment at that same $400,000 purchase price, $386,000 loan amount. So you're already saving money if you're doing this on a permanent basis, and you don't have to worry about your monthly payment fluctuating. This is a really good strategy for the long term if you're not planning on selling this home, or if you're not planning on refinancing, if you think that interest rates are going to stay high, or if you don't want to take the chance of interest rates changing or not having the ability to refinance in the future. This is a really good strategy, the permanent buy down. The other option is going to be the temporary buy down. The 2-1 buy down will look something like this. In the first year, your interest rate is going to be 2% lower than the market rate. So let's say that market rate was 6.875. Your interest rate the first year would start at 4.875. And then the next year, it would only be 1% lower than the market rate. So the second year, the interest rate would be 5.875. So on that first year, at 4.875, your monthly principal and interest payment would be $2,042. All right. So on your first year, your monthly payment would be $493 lower compared to what it's ultimately going to be when it becomes the interest rate becomes permanent at 6.875. And then on your second year, your monthly payment, principal and interest payment, is going to be $22.83. So it's going to be only $252 lower than the permanent payment of $25.35. So essentially what we're doing with the temporary buy down is that we're taking the $10,000, we're putting it in an escrow account. The bank is going to hold this money, and then on a monthly basis, they're subsidizing the monthly payment by the $493 or the $252, which is the difference in the 2% or the 1% between the temporary interest rate and the permanent interest rate. All right, so let's talk about the pros and the cons of both the temporary buy down and the permanent buy down. Let's start with the temporary buy down. The temporary buy down, just like the title says, it's temporary, right? So you're essentially taking the $10,000 that the seller is offering you as a seller credit, and you're allocating it on a monthly basis to subsidize the monthly payment, and it's going to run off, let's say, in whatever you choose. If it's the 1-0 buy down, it's going to run off in 12 months, or if you choose the 2-1 buy down, it's going to run off in 2 years. And after that, the interest rate will adjust back to the normal market interest rate, and then from there on, you're really not going to see a big benefit. The benefit is temporary. If you're one of those that are hoping and thinking that interest rates are going to go down in the future, the real benefit with this is that you're going to be able to refinance at any time, and any money that's left over in that escrow account is going to be applied to the principal balance of the mortgage by the current lender, current servicer, and you're not going to miss out on any of the benefits. So if in the first year, let's say $6,000 are used up, then you have $4,000 remaining. The $4,000 will be applied towards the balance of the loan, and you're not leaving any money on the table with the temporary buy down. So it's a temporary solution for those that are thinking about either refinancing or selling the home. If it's a home where you are only going to be for a few months or a few years, then a temporary buy down may be good for you. Now, if you're looking for something more permanent, something more long term, if you really want to see the benefits of this on a long-term basis, then you're probably going to want to go with the permanent buy down. And let's say if we were to compare the permanent buy down to reducing the price of the home, what would this do over the years, right? I have some numbers for you. So if you were to do the permanent buy down, this is going to save you, like we mentioned, $221 a month, which per year is going to be about $2,600. So what needs to take place for you to really benefit from this is for about 3 to 4 years to lapse, to pass by, so that you don't leave any money on the table. Because let's say you apply the $10,000 towards buying the interest rate down. This is going to be a closing cost. The day of closing, the lender, the bank, is going to charge you that fee, and you're not going to get it back if you refinance or if you sell the home within a few months. And especially if you're keeping the home for over 3 or 4 years, the benefits that you're going to see are the following. So in the first 5 years, you're going to save yourself about $13,000 compared to reducing $10,000 on the price of the home. In the first 10 years, you're going to save about $27,500 on the interest alone for that same comparison in the mortgage. In the first 15 years, you're going to save about $41,000, and over 30 years, if you end up keeping this mortgage hypothetically for 30 years, and you're comparing both scenarios, you're going to save yourself about $66,500 if you were not to refinance, not to sell the home with the temporary buy down. Now, let's say that you're trying to figure out how much money you need to reduce the price by to match what a permanent buy down would equal on a monthly payment. That number is $365,000. So you would have to request a big price reduction to match that $2,300 month payment. So you would have to request a pretty substantial price reduction to the seller, which they may not want to do, in order for you to match the same payment that you would have with a permanent buy down. So as you can see, there are benefits to the permanent buy down. There are also benefits to the temporary buy down, and in my opinion, they're far more greater than reducing or asking for a price reduction on the price of the home. The seller is probably going to work with you a lot more if you're only asking for $10,000 compared to asking them to reduce the price by $35,000. Now, if you're a seller and you're watching this video, possibly you're also a seller and a buyer, because if you're selling a home, you're probably going to have to move somewhere else and you're not familiar with this strategy, please also make sure that you talk to your real estate agent, because you could probably make your property more attractive by you offering a buyer a seller credit or the buy down, right? So if they use a lender that maybe your agent knows about this strategy, this can entice a buyer to maybe not have to reduce the price of your home, and this would be a strategy for you to also sell your property a lot quicker than trying to reduce the price. Especially if your home has been on the market for some time, try out this strategy. And if you're looking to buy your next home, now you know that you could also negotiate with your future seller permanent buy down or temporary buy down, some type of credit for you to negotiate with your lender the price of the mortgage instead of the price of the home. You don't need to lower your home buying expectations. With one of these strategies, I know that you could do it. If you're looking for a personalized strategy, a buy down strategy for yourself or someone that you know, I'm going to leave my contact information in the description of this video below so that you can contact me. I'm located in North Carolina, but I'm licensed in Virginia, South Carolina, and my team is also licensed across the country, so I'm pretty sure that we can help you. Now, if you know somebody that can benefit from this information, please share it. Don't keep me secret. We would definitely like to help other people that you know. Don't forget to like, subscribe, comment in the video with any suggestions of any other topics that you want me to talk about, to review. Thank you so much for watching. I look forward to seeing you in the next episode.